Hi, this is Alan Mandel at HTDT Gold at our Wall Street office in New York. It's November 6th, 2013. Well, many analysts, many Fed officials have been indicating that Federal Reserve tapering, the cutback of its monthly $85 billion bond buying program, won't occur until sometime in 2014, perhaps March. This has been my premise all along, that the economy is much weaker than people think, and that economic reports will continue to show a picture of improvement and contraction depending on the month. And it's not predictable exactly which way these figures will go, except that continuing weakness prevails. The Federal Reserve is concerned, and its concern is amplified by an article in today's Wall Street Journal. It's worth reading the first paragraph to you. It says, "The Federal Reserve could help drive down unemployment faster if it promised to keep short-term interest rates near zero for longer than currently envisioned by investors or officials," according to a new research paper by a top central bank staff member. They want unemployment down to 5.5% instead of 6.5%, which is the point at which they said tapering or even a rise in interest rates would occur. You know what that means for inflation and gold prices? It means that my prediction for 20% inflation within the next 10 years may come true, and it's going to put a nice floor and give gold and silver a nice bounce. 5.5% unemployment can't occur without wage inflation, and with a number of people working, it's going to drive up demand for goods and services. Everything from gasoline, retail sales, education, and now with healthcare, there will be a lot of spending and prices are going to go up. There's another problem down the road that has to do with the Fed balance sheet. The Fed has $3.84 trillion in assets and capital of only $54.86 billion. That's a 70-to-1 leverage ratio. Lehman Brothers and Bear Stearns had 30-to-1 and 40-to-1 leverage. The Fed leverage means that a 20 basis point increase in interest rates wipes out the capital. And this is going to go into uncharted territory with a financial crisis that will rival or perhaps be worse than 2008. It means that gold and silver will outperform every asset class after the stock market continues to rise based on Fed bond buying and asset purchases. The asset price inflation will eventually go away and revert to gold and silver, which are the ultimate hedges against a bad economy and rising inflation. I may have mentioned once before that I enjoy cooking. 2 weeks ago, I went to the supermarket to buy chicken wings, and they were $3.99 a pound. The next week, they were $4.99 a pound. That's a 25% increase in just 2 weeks. Labor costs didn't go up, there was no strike. The futures price of poultry didn't rise, and there wasn't all of a sudden a stupendous demand for chicken wings. Prices just rose. And you're going to be able to see this in every aspect of the economy. Inflation is what drives gold and silver prices higher, and this is what we're looking towards in the next 3 to 4 months, the beginning of 20% inflation over the next 10 years. That's all I have to say today. This is Alan Mandel, HTDT Gold, 75 Wall Street in New York.